We do know that African markets are vulnerable to the current global volatility we've seen. Among others, we see East Africa struggling under the drought situation that persists. Nigeria is experiencing some tension with its banking reforms, deadlines of September. Malawi, we see riots and fuel shortages. Joining us now for a look at these factors is Roy Daniels, the head of Africa Trading at Rand Merchant Bank. Roy, thanks so much for your time. Slight recovery we've seen in today's session, but basically it's been a bloodbath internationally since those ratings agencies decided to downgrade America, and obviously those persistent debt issues in Europe. What is the immediate and direct impact on Africa?
I suppose, Loratu, firstly, when we look at the impact from a risk-off environment, I think Africa is going to suffer partially by it. I think that guys are looking for safe haven places versus Africa, which is a bit more risky. I think that the advantage we might have had in the past, where the yield was an advantage for us, I think that's now disappeared, and guys will go safe haven. We look at the gold price. It's just a problem for Africa, I think, investment-wise.
I mean, in simple terms, the problem here is that effectively a downgrade means that the cost of borrowing rise, and a lot of emerging market economies have their commercial banks geared towards the United States. What direct impact is that going to have on an economy like South Africa, for instance, and then any other bearing within the rest of the continent? Because we're often told that the immunity we've experienced is because we're not exposed as sub-Saharan Africa, although South Africa's a different picture.
I think on the sub-Saharan side, I mean, with the downgrade, as I said, we're going to have the cost of funds going to go higher all the time, as you've mentioned. This is going to impact these central banks who are going to have to pay a bit more for investments. And certainly for their own funding costs as well. We're going to have to see the higher interest rates across Africa. It's going to make it more expensive for them to fund themselves. So I think that if we look at the total cost to their GDP, it's going to go up all the time. It's going to impact them financially. It's going to impact them on their taxes they're collecting. They're going to have to collect more revenues to fund themselves going forward. We look at, especially in the case of a place like, I think, Kenya. I think they're trying to force their rates lower by not hiking rates. I think that's going to impact on them negatively quite harshly. They've got to hike those rates. They've got to pay more for their funding.
Let's look at the situation regionally, starting off with East Africa. Other compounding factors, a drought that's persisted, that's created huge inflationary pressures, a weakening shilling, and in fact a weakening currency across the board, not just in Kenya and Tanzania and Uganda as well. What additional bearing is that having?
I'm not sure they need any more additional bearings as to what they're holding already. I think if we look at the drought situation, as you mentioned, that's a huge impact for them, and of course for the region. Everything's flooding into Kenya, and Kenya can ill afford it. They've got their own problems as well. I think fiscally, I'm not convinced that they're managing it the way that makes for investor confidence. And I think what they need there, what they need to aim at is how do they get investor funds coming back into the country? How do they come into buying the bond markets? How do they come to buying any sort of yield product there to actually get some funds back into the country? So I think, yeah, I think with the drought, with the high inflation, imported inflation from the rest of Africa, it's a huge problem for them.
I mean, moving further south, we've seen those political riots in Malawi. Citizens just fed up with the rising cost of living, and of course they've lost a significant proportion of their aid with the whole diplomatic spat with Britain and increasingly with other multilateral donors. What does that mean for Malawi, and in fact if it's going to spill over into the region?
I think Malawi has waited long to actually get into looking at what needs to be done. I think too many central banks in Africa become reactive instead of proactive. I think reactively, they've now looked at the situation. They've had the very unfortunate riots and the people getting, I think it was 19 people killed. That's forced them to then weaken their peg. I think they've weakened their peg now from 152 to 165, which is going to go a long way to ease the concerns in the country. A weaker currency would be much better for the exports. They'll start, I mean, their tea exports could go up. Tobacco prices are low, but tobacco will get better. So I think we could actually then see some benefit from the weaker currency. And of course, the IMF will now look at the loans back into the country.
Now, Nigeria, for me, is a bit of a complexity, because we've seen very decisive action on the part of the central bank, both in terms of hiking interest rates, in introducing reforms, in sticking to a schedule and a deadline, in reducing those restrictions on foreigners who hold their government securities, but it hasn't buoyed the market. What's the problem here?
I think they've been proactive, but again, it's a matter of we need to wait for the markets and the whole general financial sort of situation to calm down before we see money flowing back into Africa. Nigeria is not a safe haven. You know, it's a risky market. I think that the proactivity of the central bank there would lead investors to look at that market and say, we can trust the central bank, we can trust what's going on in the currency is holding up well. So when things do settle down, when the dust is settled, then we can look at then attracting money back. I think Nigeria will be one of the key markets going forward.
All right, now going forward, what is it you'd like to see authorities do, particularly by way of the central bank? You're saying in Kenya we need to see bolder action in terms of interest rate hikes. Their problem, though, is that they need to manage inflation, and yes, they could raise hikes, but they don't want to make it expensive to live. They don't want to make it expensive for banks to borrow, because already on the interbank market there have been some liquidity issues.
I think going forward that we've got to see bolder steps and statements from the central banks. I think when there's uncertainty in the markets, we need the central banks to come out and quell these uncertainties. In Nigeria, there's a banking crisis. The central bank came out and issued a statement almost immediately. Calms the market down. Investors like that. That's what we as investors like to see from markets. So the Kenyan situation, I do realize that they've got to keep it down, and they've got to worry about growth. They've got to keep costs down and the cost of inflation down. But eventually the currency needs to find the correct level where it needs to get to assist you with it. South Africa has benefited immensely from the stronger rand.
And just in general, the trends that we're seeing, you said, we do need to see central banks stepping in and be proactive in Africa. What does that mean? In the United States, for instance, the Fed has just said they're going to continue with low interest rates because they've also got to worry about growth. Many central banks in the region also struggling with these two things, manage inflation, but support the growth agenda as well.
I think that we've got to have clear fiscal policy from the guys and a clear fiscal message from the central banks. We can't have situations where we hike an overnight rate 175 basis points and 11 days later we cut it by 175 basis points. That just leads to confusion, and investors don't like that. They want to hear your fiscal policy from the central banks. They want to know that you're taking steps to quell inflation, to keep a lid on inflation. How do you keep it in check? How do you check it without negatively influencing growth? But I suppose who would want to be a central bank right now? You've got to balance inflation with growth. So it's a tough job. But I think clear statements from them and to just sort of ease the investor community out there to actually come and bring funds back into Africa to buy their bonds again. Right. Once the dust settles, once the markets calm down, we're in a terrible crisis. I don't think it's not going to last forever. So we need to prepare ourselves and get our house in order for when time is right.